Welcome to Module 5. This module is all about flow-throughs, and so we're going to spend a lot of time talking about partnership taxation and then to some extent S-corporation taxation. So let's go through the Module 5 learning objectives. So we're going to distinguish the entity approach from the aggregate approach for taxing partnerships, and we'll talk about what those are today. We'll talk about tax issues related to when we form a partnership or acquire partnership interest. We'll talk about how partnerships choose accounting periods and methods. We'll talk about how a partnership reports its income. So by now you should know it has to report its income out to the partners as a flow-through. We'll talk about how that's done. We'll certainly spend some time on partners' tax basis. We've already started that conversation. We will continue it in depth through this module. We'll talk about basis at risk and passive activity loss limits. We've been there before, now we get to apply it again. We'll talk about the requirements to elect S-corporation status and the S-corporate methods and periods and how they also allocate income from operations, just like a partnership does. We'll talk about some of their loss limitations and then some of the unique characteristics related to self-employment income and fringe benefits. And we will talk about the tax rules when an S-corporation makes a distribution. Lastly, we will talk about taxes that apply to S-corps, but just briefly, and then we'll talk about some of their compliance requirements. Okay, so this should be an overview of items that we have talked about before. If ever there was a video you could skip, it might be this one. So we know that income earned by flow-through entities is not taxed at the entity level. And we know that the owners of the flow-through entities are taxed on their share of the income that is allocated to them. And lastly, we know that flow-through entities are only taxed once, unlike a C corporation. The only time the taxation occurs is when the income flows through to the owner. So the aggregate and entity concepts are sometimes used to describe the way partnership taxation works. The entity approach says, well, partnerships are a separate legal entity apart from their owners. However, from an aggregate perspective, a partnership treats the aggregate of each partner's interest in assets and liabilities as the partnership's assets themselves. And one of the most basic tenets of partnership tax law, partnerships do not pay taxes. That reflects the aggregate approach. Partnerships, on the other hand, rather than partners, make the tax elections that they represent. So that reflects the entity concept. So types of flow-throughs, we've seen these before: partnerships, limited partnerships, LLCs, S-corporations. A partnership is when more than one persons engage in business together, and that actually includes a husband and wife. So a husband and wife, if they are in business together, that is not a sole proprietorship. That is actually a partnership. But there is a tax election called a qualified joint venture that isn't really covered in the book that allows a husband and wife to treat each of their shares as a separate sole proprietorship. So you have a spouse that works in business with you and you're a sole proprietorship and you do not treat that person as an employee, then you could be in trouble. So Bikini Bottom Partnership has two partners, SpongeBob and Patrick. Both contribute $40,000 for a 50% interest in the partnership. And let's say the partnership earns the following in 2018. So some ordinary income, $10,000, long-term capital gains of $3,000, and tax-exempt income of $4,000. So concept one, that the income flows through, would require that SpongeBob and Patrick each recognize $5,000 of the ordinary business income, $1,500 of the long-term capital gains, and $2,000 of tax-exempt interest, which of course they don't really recognize on their individual tax returns. And then they both pay whatever taxes due based on their individual situation. Concept number two is that that income is taxed only once. So the Bikini Bottom Partnership distributes cash of $10,000 each to SpongeBob and Patrick. And as long as this is from either the earnings of the partnership or those partners' contributed capital, it should be tax-free, because to do otherwise would be to tax it twice. But note that there is no earnings and profits concept in partnership tax. Instead, everything, or just about everything, hinges on this idea of the calculation of basis that we're going to start in the next video and continue throughout this entire series of videos. But that brings us to the end of this video 20A. Thanks for watching.